Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing, while also documenting their own personal investing journeys, are your hosts, Corey Jacobson and Ryan Bevilacqua.
All right, welcome back to the Weekly Juice. Ryan always says, as always, Ryan and Corey here, but today you just got Corey. We have a great episode, though. Charles Carillo came on today. He's the managing partner of Harborside Partners, the real estate investment syndication firm. He's been actively investing in multifamily and commercial real estate since 2006. And since then, he's invested over $200 million worth of real estate. And he's also the host of the Global Investors podcast, where he interviews professionals about real estate investing across the United States. He does like podcast episodes like us, and then he has like short segments where he talks about a specific tactic, which I think is pretty cool. Charles and I had like a little Tampa, Florida connection. He invests down there, and he lives in Florida as well. This guy has, extensive knowledge in the real estate investing, from buying his own properties. He bought a 3-unit, bought a 5-unit, bought it with his own money, eventually ran into the inevitability of running out of his own money. And he, started getting the syndication route. What's funny about his story, I don't know if it's funny, but it's just a tidbit here, that his father was in the D-class properties, right? Like he had, I believe, over 100 units of D-class properties. So he talks about what he learned about what not to do, or like just maybe what to do if you really want to take that on. His father used to go house to house, collecting cash, sitting down, talking to people. And what I thought was funny is he said at that level of real estate investing, everything is negotiation. So it's like, yeah, you show up and you might get rent, but you might not. And but this is the person that was, doing what not a lot of people want to do. So it's funny because I guess that's how he was able to succeed. Great episode today. Charles is energetic, and he has a lot of great knowledge for people to latch onto. You can apply this to whether you're doing, syndications, whether you're just starting out in real estate investing. There's a bunch of strategies within this episode that you can use. So without further ado, let's bring in Charles.
When you have investment properties and tenants, you need a good system in place for collecting rent to make it easy as possible. And RentRedi can help you with everything. When you sign up for RentRedi, you can start adding your properties, inviting tenants, and creating charges. You can even set up automatic rent reminders and create auto late fees as well. For tenants, they can pay via ACH, card, or even cash using RentRedi's web and mobile apps. They can also use an automatic payment setup and sign up for rent reporting so they get rewarded for paying rent on time. RentRedi saves you time and hassle by automating rent collection, and you can manage everything from one dashboard. For our Weekly Juice listeners, RentRedi's given us a special 50% off for any RentRedi plan using our code WeeklyJuice at rentredi.com. That's RentRedi.com using the code WeeklyJuice. That's WeeklyJuice to save 50% off any RentRedi plan.
Charles, officially welcome to the Weekly Juice podcast. You have half of the Weekly Juice members here today, but hopefully it'll still be a good episode. I'm excited to interview you. Thank you so much for taking the time out of your day and coming on. And we're excited to share your story with our listeners, so thanks so much.
Thank you so much for having me on. It's great to be here.
Cool. So Charles, give us a little background on who you are, where you're from. I know you have an extensive background in the real estate business, mainly syndications now with Harborside Partners, but everyone had to start somewhere, and I imagine that you didn't raise capital for your first deal. So maybe you did, but give us the inception story, about you, and just tell us how you came up in this business.
Yeah, so I grew up in a small town in Connecticut, and I moved down. I live in Florida now. I moved down here in 2012, but I grew up in a real estate investing family. My dad became a multifamily investor a few months after I was born in 1984. He owned a lot of D and C class properties, which are not ideal. Not really C class, they're really D and some C minus, let's just say. And so he self-managed them. He had a partner. They grew that to 100 units and started selling it off in the late 90s. But they were very tough properties. And it was something I wanted nothing to do. But it was my second education of going down there. About 50, the properties were in a city about 15, 20 minutes from where I grew up. And everything, collecting rent, dealing with contractors. He had superintendents that like ran most of it. But at the end of the day, as I saw everything, you have a lot more freedom what he had, and he had all these benefits. And there was a lot of there's all the issues with dealing with that type of properties, from the tough areas they were in. And it's just you're dealing with a lot of tough people in those properties. So it is it's a very tough business. And I got out of college in 2006. I bought my first property, which was a 3-family property. Now they call it house hacking, but back then it's just living in one, renting out the others. And I then bought another one in 2008. So end of 2008, end of 2006, completely different times. And then in 2009, I bought my first commercial property, which was a small mixed-use property. And that was completely vacant. In 100 days, I had that thing fully rented out. It was only 5 units, but it was completely vacant when I purchased it. It was during the winter of Connecticut, doing overall outdoor stuff, exterior stuff, interiors, all the units, multiple people going on in the job, teams. Got it done. That was my largest to date at that point project, because the other ones were not as bad. The first one was a little heavy, but the second one was really turnkey, and the third one was very heavy. So after that, I started dealing with a lot of smaller commercial properties for several years after that. And then in 2012, as I said before, I moved down to Florida. I had hired a third-party manager, the first third-party manager I've ever hired him to manage my properties. And 10 years, I sold those properties in the beginning of 2022 in a whole portfolio deal to a investor outside of New York. But, being in Florida, I got involved with a little larger commercial multifamily properties. So when I say commercial multifamily, anything 5 units and above. And in about 2018, we got involved with syndications. I never really wanted to raise money for deals, but it was, as a mentor of mine was telling me, he's like, it's the only way you're really going to be able to grow your business is taking money from other people. So did that, and started. First syndication was a 59-unit apartment building in Tampa, and I was living in St. Pete at the time, so it was pretty close, and went from there. We sold that, I think, in 2022 as well.
Oh, so do you live in Tampa?
No, I live in Palm Beach Gardens, so other side of the state now.
Yeah. Okay, got it. I have a property in Tampa. I love Tampa. So
perfect market for investing. Yeah.
And as you've seen, I'm sure in the last, you said 2018, the last 6-7 years, whatever it is, it all has so much more room to grow too. Tampa is, for everyone listening, we love Tampa. So that's awesome. I'm curious about, you without your dad's expertise in the C&D class, you probably wouldn't have learned what you didn't want to do, right? Because everyone that hears about real estate investing from the outside perspective, they're like, oh, these real estate investors are financially free. They're driving around in Lambos and they're just doing whatever they want. They have the completely free lifestyle. But if you're self-managing a D-class property, first of all, he probably was self-managing because no property management company would even take it under their wing, maybe, right? But I'm curious, what were the biggest takeaways that you learned that you didn't want to implement into your own business once you got started?
That's a great question. Don't pick up rent in any type of fancy car. My dad had an old Caravan, and that thing leaked everything. But anyway, it was just my first real estate book I ever read was Art of the Deal, in 1998, Donald Trump's book, and I started asking my dad, I'm like, why don't you have a manager for this? Because he's telling the story about him and his dad buying C-class properties and stuff and all over the United States. And I was telling my dad, and he was like, tell me why you wouldn't have a manager. And he's like, they don't know how to do this kind of property. It's a different grade from what Trump's buying. Trump was still buying C-class with his dad. You know what I mean? This is still before he went to Manhattan. And he's like, they take too much money and all this kind of stuff out of it. So there was a number of reasons why my dad wouldn't do it. But it was when I did hire it, there was one thing he pressed upon me was that buy better properties. And he did that at the end of his career too. My dad sold a bunch of mainly all of his problem properties at the end of the 90s. And he started buying smaller properties in better areas in the same city. And that was something that 3 families, he had some duplexes, stuff like this. He was buying stuff because he was finding that he was getting into better areas. They'd have smaller complexes. That's just how the city was that we were investing into in Connecticut, and less problems. And then when I bought properties, it was something that he just pressed upon it. My brother bought a property, I bought properties, we bought some together. And when we did it, he was just my dad never invested into any of our properties. And it was just something that you just kind of bring properties to him and be like, hey, what do you think? And he never shot him down, but he would always you would know that he wasn't impressed with the ones that are in tougher areas. You know what I mean? Sure. And so that was something that I always press upon people. If I'm talking to them, if I'm mentoring them, I'm just listen, buy better properties. Everything just is, you're taking care of so much issues up front. You know what I mean?
Totally. Yeah. So it's funny you say that because Ryan and I had an opportunity to invest in Cleveland, Ohio, when we were first getting started, and we're still relatively young in our journey. I mean, we've only been doing this for 4 or 5 years, but like we saw this portfolio out there, and the properties are $20,000, $30,000, $40,000, $50,000, and the rents are $1,200, $1,400, $1,500, and we're looking at this on paper, and we're like, this is unbelievable. Like they're like this is the cash on cash return is 100% or whatever. We go out there and we take a look at these properties, and I'm thinking, there's no way we're collecting rent, or maybe we are for 6 months, and then something happens, or the properties, it gets dilapidated and whatnot. So we decided to not go that route. And the reason I bring that up is because I found that it is so much more beneficial to take less cash flow to have a better area, better properties, because what'll end up happening over time, this doesn't happen at first, but this, over time, those properties will end up becoming much better on the appreciation side. If you wait it out, right, not necessarily 1 to 3 years, but 3 to 5, 5 to 7 or plus, you'll end up making more money over time as opposed to diving all in on the cash flow. But if your dad was able to build this business on the way he did it, and he was better than other people, then you have that route too. So it can be done both ways, but it's a very interesting, cash flow versus appreciation. It's the tale as old as time.
Yeah, it's for sure. And I remember one time we were leaving there and everything was picked up in cash. It would be very rare that he got like a money order or anything. And I remember he just had like a whole thing in cash. And he's like, oh, like half of this is profit. And you're like, oh, wow, like that's how it works. And that he had a mortgage and everything on it. That's how much these things cash flowed. You know what I mean?
Yeah.
Like, now they have the 50%, or they always had this, but 40, 50%, expenses to gross. And that must have been like 25% or something with then a mortgage on top of it. But yeah, they were tough properties. I mean, some of them, he didn't put any money into them. We got them signed over to them. All this stuff they used to do back then before like due on sale clauses and stuff, like quick claim here, all this kind of stuff. So you get a lot of properties that people just got into, and like they saw, like, like you would buy that property and you'd see, and you're like, oh, this is like terrible. I want out of it. I don't care about my down payment. And my dad was like taking over some of those properties. And so
there's definitely a market for it. Yeah, definitely a market for it.
Yeah, people can do it. I mean, there's people, people have to live there. People have to do it. It's just you have to self-manage it. And you have to have people that everything's a negotiation. If you think you're going to get mailbox money, you are in the wrong business. It's something like every month is a negotiation. You know what I mean?
Interesting rent. Put it.
Yeah. It's just like we would have to go. He would have his supers collect most of the rent, but I would go with him. Like in elementary school, we go apartment to apartment, picking up people's rent that was from behind. And he'd walk in there, and he had like this old school spiral carbon copy receipt book, and he'd sit at their table with their like plastic cover on it. And he'd write out receipts, and he'd count the money, and he'd say something, talk to them for a few minutes, cordial, and go to the next one, and go to the next one. And like, I never collected rent like that before. It was all at the door if it was cash. You know what I mean? When I may self-manage my properties, but like, man, that was a very personal thing of like collecting money and having an intimate relationship with the landlord. You know what I mean?
Yeah.
And then you'd leave
takes a certain temperament of a person to do that. So very cool. I want to talk more about your journey too. And Charles, there's an inevitability that you run out of your own money when you're investing in real estate. And I didn't want to start doing projects with other people and taking less of the, not just less of the risk, but I didn't want to take less of the profits and have less equity. But I'm curious about, as you started to grow, were you, saving up your own money to buy this 5-plex or to buy the 3-plex? Like, was it that, hey, I need to save 50 to 100 grand, rinse and repeat for the first several years as you got started? Or what was that journey like in terms of when you were doing it on your own? And then we can talk about the transition to syndications.
Yeah, now they have like, the BRRRR method. It's really big. Like no one was refinancing properties at the end of 2008. I mean, everything went to shit. So it's like, there's no properties there's no money available to refinance it. And definitely 2009. I mean, 2009 was a bloodbath. So it was just, you had to have cash. I had cash from another business I was running, and my brother actually runs it full-time now, an online business. But I was just taking all of the profits I was making there and putting it into real estate, and that's how I purchased it. I did refinance those properties down the road. I refinanced one in 2010, one a couple of years later after that, and pulled money out to put into other projects. But at that time, you had to have that money sitting there. I remember after I completed that first commercial property, I went to a bank that I had a relationship with from doing business banking with for several years. I asked them, I told them exactly what I paid. They knew exactly what it was. I showed them the work I did to it. they're ready to loan me in, I think this was at the end of 2009 or no, it was like 2010. They were going to loan me. It was like 15% loan to cost, not even like any kind of value. So it's like whatever, all the money I paid for it and put into it, and this thing's cash flowing. The bankers were out there on my porches that I just spent all this money on doing. They walked all the units. Like there's no fluff here, right? You can like talk to every tenant. I got signed leases in my hand. 15% like loan to cost. I mean, it was nothing. I mean, like it's just like that's just pretty much just like, hey, we don't want a loan on this. You know what I mean? So
Totally.
it's like that's how it was. So there was no refinancing at that point. So a lot of those strategies don't hold water. And I went to private money. Private money is like, I'll give you like 50% of what you paid for it years back. And you're like, that's like, I mean, that's not going to do, I mean, I can't do anything with that, you know?
Yeah, absolutely. So then, fast forward to you have what, 10, 12 units or so of your own, maybe more, I don't know.
Yeah.
What was the point when you started to pivot and go into the syndication route? Because now Harborside Partners has over $200 million of real estate transactions since 2006. I'm reading this here, but I, so you've come a long way. I'm curious about maybe your first deal where you started to raise money, that transition to like maybe the mindset shift. Like It's not just my money now. Some people take it. I'm of that mindset that like if I'm raising capital or I'm working with other people's money, their money comes before mine, right? And because your reputation is all you have, and that's really what comes into play there. So I'm curious about how that transition went for you, and maybe what that first deal was like when you started to raise.
Yeah, it was different because I had people that I knew in business relationships that wanted to invest, and there wasn't a clean way of taking money other than the syndication route. Because you're like, do I want a joint venture and buy these small properties? Like the management's a hassle. They have to be involved with it. It never worked. And then, so going the syndication route allowed it to be a lot cleaner of a deal. You know what I mean? You put money in and it's 5 years, let's just say 5 or 7 years. And you put money in. Once the property like really starts making money, once we get it on the upswing, we can start paying out distributions, and then it's nice and clean. You know what I mean? You get your tax report at the end of the year. You don't have anything to do. You know what I mean? We're not asking you to do anything. You have no responsibilities after you invest. And so that was the cleanest way. That's the best part about the syndication model, because I would tell people about what I was doing for years. And then I was like, I don't know how you could get involved with it. You know what I mean? Because it's like so I learned about syndication initially, like back in like 2008 or something. I was like, this sounds like terrifying, but it's one way of really growing. And if you have a good team, if it's done correctly, and the people are actually experienced that are running the deal, then it can be very, very, very profitable. And it's a great way of going about it. But raising money. Yeah.
Cool. So, I mean, how do you structure, either you want to maybe just pick a deal that you've done or one that is in theory, whatever you'd like. I'm curious about how you structure it, and I can give you an example of one of the ones we've done where there's like a 6% preferred return, and then there's an 8% return on the back end for a total of 14 when the property either refis or sells, and that kind of builds in the background. I'm curious, like, what's the way that you've structured deals for a passive investor to come in? Because playing with the stock market is it's for some people and not for others. And that's obviously really passive, but you have no control. You're not the CEO. You're not running the business. If you can park money with someone that you really know, like, and trust, I think that's a game changer.
Yeah, for sure. There's so just like the syndication is just a little overview here for people that might not know. So in the syndication, there's two parties you have. You have limited partners, passive investors, and then you also on the other side, you have the deal operators, the general partners, sponsors, whatever you want to call them. There's all these different names, key principals you'll hear. Those are the people that are running the deal. They're doing everything. The limited partners only have to put money into the deal. They do their due diligence on the sponsor, on the deal, and then they invest and they're done. Okay. The general partners are doing everything. They're putting together a team. They're fighting the markets. They're fighting the properties. They're dealing with everybody. They're buying the property, renovating the property, executing the business plan, selling the property, giving your money back, hopefully. So that's kind of how that works. And what we would do is they become a lot more in-depth now, these agreements. But initially what we did is we did like a 70-30. And when a preferred return, I believe it was like 7%. So what that meant is that the first 7% go to the limited partners. And then what happens after that is we're going to split 70-30, with 7 out of every $10 above that is going to go back to limited partners, and 3 would go to the general partners above that $7. You know what I mean? So that's the structure that we would typically do. And there's some stuff, down the road that if we get into a certain higher level, we put that instead of 70-30 to 50-50. But for the most part, that's how the deals are structured. And now, as the deals have gotten bigger, they're a little bit more complex because we are raising more money for them. This was like, that's a simple thing for raising a few $1 million. You raise a couple $1 million. I think on our first one, we raised 1.8, and then I think like 2.5 on the next one. So as they start getting to like $6-7 million, that's when you're going to be incentivizing people to bring bigger checks in, right? And so we're going to have different classes of investors, okay? Yep. And that's getting into a complex thing, but that's how we do it, to bring people in and give them a little bit more for writing a bigger check. And but initially, that's a simple deal. That's how it'll be structured. And then you can use that kind of structure framework to see exactly how the different classes are broken out as you start getting a higher percentage of the deal.
That makes perfect sense. And then, you get into the class B or C, 506B or 506C, whether or not the investors need to be accredited or not, whether it can just be friends and family, whether you're able to, and that's on the B. And then on the C side, it's like you're able to market it, but everyone has to be accredited. So you yourself have invested in over 3,000 multifamily units, active and passive. So I'm curious from someone who's done it on both sides, because this community is it gets pretty tight knit. Like once you start to raise capital and build a real estate portfolio, you start to meet other people who are doing the same, which is I imagine the active side for you and then the passive side too. I'm curious, what do you look for? You can wear either hat, right? The passive or active hat, but I'm curious now in 2024, as we talk about new deals, like what are key metrics that you look for when you're looking to either buy a property or invest in somebody else's syndication passively?
Yeah, so I would look, number one, it's, off the top, you go state, and then you get into the city and county, stuff like that. So I want to make sure all that's landlord friendly. And that's very basic information, right? Because there are some
states. You got to follow the politics there for the most part.
That's true. That's true. You don't want to say that, but that's exactly how it is.
It is what it is. Yeah,
it is what it is. We're trying to make money here, right? So the thing though is that we want to make sure we're all landlord friendly. From someone that's spent decades in non-landlord friendly states, take it from me, you only want to invest in landlord friendly states. So the thing though is that's number one. Then we're going to get into, we look over the market, like Tampa. Just look at Tampa over the last 20 years, and you know what a perfect market is, right? We've seen population go up over the last 20 years by 1 or 2% a year. We've seen jobs go up by that percent. We've seen crime go on the inverse down. And when you see that over a 20-year period, you know exactly where we're heading, right? Or where that market is actually going into the future. And that's when we know it's a good market. So that's another thing. And then I want to, if I'm passively investing, or even if I'm partnering with someone on the ground, like an operator on the ground that I know, it's something that we're going to look at really into their team, exactly who's boots on the ground, and really that property management company. More and more, I like to see when you're doing a deal, I like seeing that they have multiple deals in that area, in that market, being managed by the same property management firm. And I've spoken to some people that avoid that, but I like doing that because if you have already managers that are managing a property, and say this is your fifth one, right? They have 4 other ones with the management company now you're doing. Well, I know there's a very low chance that you're going to have to switch that manager. They're doing well at these other properties. So that's good, because switching management is a pain, right? So it's something that you want to make sure they don't have to do that. They already have that set up. If they've done multiple deals in that market, value adds, renovations, they already have contractors available, right? Plumbers, they got electricians, they got GCs, they got everything they're going to need to renovate properties. They're not going to reinvent the wheel with my money going into that deal or my investors' money going into that deal. So those are some of the main things I'm really looking at. And yes, you can get into more deal specifics when you're looking at their underwriting, and you seeing as you get more into more experienced groups, for the most part, their rent comparables are pretty much right on. But for the first time when you're reviewing it, see what they're using for rent comparables and do your own research on it. Because if you're buying property and the units are at $1,000 a month and they say it's going to go to, the market is $1,400, check out what those comparables are. Are they same vintage? Is it nearby? I mean, something a mile away might as well be in another state, because it doesn't matter. You know what I mean? And I want something that's across the street, that's a year or two older, that's getting those $1,300 a month rents. And then we can do our underwriting at $1,225 or $1,250 conservatively, knowing over 3 years we're going to get there. And then you have a plan of what you're doing and how much money does it take to get there. Yeah. So I think that's
great advice.
That's kind of in a nutshell, what I would look for when I'm getting into a deal is the team, and then getting into the deal specifics of where that deal is supposed to go.
Great. So, I mean, we talked a little bit about Tampa here in the episode. We both have some commonalities. I'm curious, does Harborside, like, is that a market that you're focused on exclusively, or where do you look, when you're looking to buy? I know you mentioned some of the landlord friendly states, but I'm curious, like, where does Harborside have most of their properties? Is it Florida?
So we have 3 markets right now that we're focused on. We have DFW, so Dallas, and then we have Greater Atlanta, and then we have in Florida, we like between, we do I-4 corridor, which is between Tampa and Jacksonville, with Orlando there in the middle. And that's kind of in our backyard, and we have an operator there that we work with as well. So depending on where it is on that I-4. But the thing though is that that allows us, those are the places that we've really, the key though is going into these markets and knowing that obviously I'm not going to be an expert from South Florida on Dallas, right, or on Atlanta. However, partnering with someone there, and we have a great deal there that we purchased a few years back, and it's something that, for example, it was one of our first deals there, and it was somebody that has already, I think, like 4 or 5 deals prior to us buying this. Now they have like an extra 2 there. So it gives you a base that I wouldn't be able to replicate. However, it also gives us the ability to diversify my own income, my partner's income, and also our investment capital, and also our investors, right? That, I have investors in Florida. Everybody's always worried about hurricanes in Florida, right? So for good, for good measure, right? So the thing though is that, hey, there we have Dallas, you know what I mean? We have Atlanta. We have other places where we have trained people on the ground that we can partner with, and that we can, we can put money into their deals alongside them. They're going to be running this part of it. We're going to be running this part of it. Be completely honest of what's happening. And it gives diversification to us and then to our investor base.
Yeah, that's great. I mean, to shout out to Sean Winslow, who runs Greenbrier Capital. Ryan and I are partnered with him on a project in New Hampshire, which is where he's from. And the reason why I bring this up, Charles, is because having Greenbrier is stationed in New Hampshire. They have this property that's running in New Hampshire. They also have properties in other states. But the fact that you mentioned that somebody is there, boots on the ground, that are operating the project, that property manager found the deal for them that they have other properties with. There's this tight-knit community of people that are all kind of striving for the same thing. The property manager is making money. Sean and our team is making money. And he lives 30 minutes from this specific property. So I love that you mentioned that there's this like... you have, even if you don't have to be the boots on the ground, right? And none of the passive investors are going to be boots on the ground, but you have to have somebody, obviously, who's either has those connections, whether that's in not necessarily the government, but like the municipalities, who's working with some of the permitting, who's doing the general contracting work and the others that you mentioned. So I think that's a major key. And if you don't have those metrics, then I don't see any reason that you should invest in a deal like that. So I think that's pretty cool. Question I have for you is, I'm curious about some of the biggest mistakes, maybe that either you've seen over the years or that you see other investors make, or maybe that you've made yourself. I mean, what is it? If you want to go into a mistake that you've made, the episode's too long or too short for me to list out all the ones I've made. So maybe if you want to list them, but anyway, just some mistakes that you've seen or that investors make, throughout the process.
I think buying, see here, so miss budgeting, right, for my renovation projects, which is a big one. So that's a big one. And it's also, if I did again, whenever I do a deal that's like a JV deal or any type of deal, you know what I mean? If you're doing it and it's not a syndication format, you're putting enough money away because when you're syndication, you have a set thing. Here's all the things that we have to do in 5 years. Everything's being put away for this, and there's a reserve on top of it. If you're doing it with a joint venture with other people that are all active, that's something where like, hey, we got to do a roof in 5 years, but it's something that's going to be, we can put that money in at that time. You know what I mean? We don't have to put it up front because you don't want to be going back to investors in that syndication. So I think misdoing mistakes with budgets, I think buying properties that were not doing enough knowledge on where, just because a neighborhood or a market is good, everything changes by block. So buying properties that were the right size, because if you bought properties with units that are too small, you might have more turnover. You buy properties, I found out buying properties with 2 or 3 bedrooms that were a little larger, we're going to keep renters for much longer, many, many years. And the key in multifamily is keeping people longer. I think that was it. I think not getting into better properties faster. I was in like C-class properties. We sold our last one last year. 2023 was our last C-class property that we had that we sold. So taking more time to get fully into B-class, because B-class, as you mentioned initially, you're getting a mix of the cash flow and the appreciation. So that's what I would see. I think mistakes maybe other people make. I think not having enough money in reserves. So when I speak to new investors, it's always, they want to buy $1 million property and they're always worried about like, let's just say $250,000 for the down payment. That's all they care about. And it's like, that's completely a mistake. You don't know exactly. There's going to be any property you buy, no matter how turnkey someone tells you it is, it's going to need work. So you need to know exactly what renovations have to be done, what updates have to be done to it. And then you have to put all that money aside. Plus you got all the closing costs, plus you got everything else. And you need to have a reserve fund, which should be at least 6 months of your expenses. So then that might be $350,000, right? $400,000 if you're getting a 25% down. That's what you should be putting. That's what you really need to be focused on if you want to buy this property. Now there's creative ways of doing it where you can maybe lower that. But the thing though is that have that money going in and thinking that you're going to cash flow any of these large projects by what property makes, it's just not going to be a thing. You got to make sure you put that. It's one thing if you're like repairs and maintenance, right? Changing faucets and stuff, I can cash flow that. But like you're going to cash flow a roof 2 years in, I don't think so. You know what I mean? Like make sure you have that money up front. And these are mistakes I see people make. And it's things that I kind of like, if I see someone doing it that I'm like coaching or something, it's like you have to put your foot down right away. And you're like, no. Like these numbers are way off. Because if you go in there, yes, real estate, you can fix like almost all problems by writing a check. However, you need to have the money to write that check. And having that up front, because we're going into properties when we do like you're doing the value add, we're going into properties that are somewhat stabilized. We're disrupting them, right? And then we're putting them back together. So during that time of you're disrupting this property, no matter how big it is how long it's going to be disrupted, you're not going to have consistent cash flow, right? So you have to make sure you have that money available for expenses, for debt, for everything else.
Yeah, at the end of the day, Charles, you got to be able to sleep at night. And I think that's why do any of this if you can't have peace of mind? Truly, right. Like it doesn't, if you're just creating another super stressful job for yourself, you might as well go work for someone else, right?
That's
I mean,
true.
the fact is that if you can sleep at night, I think the 6 months is great because, and I think that can scale down to any property. If you have, I realize if you're just starting out, that's not easy, but start at 3 months, but try to get to a point where you have 6 months. And then if you have 25, 30, 50 units, maybe you don't have to have 6 months for every property, but having that peace of mind, knowing that if something happens, if $6,000 expenses happen in different units, you're going to be okay. So the reserves are such a major factor, especially for people that are just starting, because it's hard to do, but it's necessary because I've seen the worst. Ryan and I had a property that burned down this year, and thank God we had insurance, but there was moments in time where we're like, I wonder what this is going to come out of. Like, what are we going to be down? Right. Even to cover for the people that come out to board up the place, or to cover lost rent until insurance kicks in, all of these things. It ended up working out great, and shout out to our insurance company, but that's why you have insurance. So to have those reserves and to be prepared is really, that's kind of a winning formula, in my opinion, in this game. So,
for sure.
I'm curious, Charles, about your future goals with your business. What does Harborside look like in 5 years? What are you trying to accomplish? More properties in the Dallas, Fort Worth, Atlanta, Tampa area, or Florida area, certain number that you're looking to get to, units under management. What's the metric that you would say, oh, you know what, we're doing pretty well. I think we've made it, so to speak.
Yeah, it's kind of, it's difficult doing this.
It's a loaded question, by the way. Yeah.
Yeah, it's like, we're going through a difficult time now. Now, we sold the majority of our properties over the last 2 years. Okay. And so it's something that we didn't do any deals in 2023. So I'm very selective on deals. We have a small team, which means that we have very small overhead. So it's something that, if deals pencil, we'll do them. You know what I mean? And if that's going to be 0 deals a year, if that's going to be 5 years deals a year, and different sizes. I love doing, what I like doing is 1990 and newer built properties, 100 plus unit deals, all this kind of stuff. Now, sometimes you have to change that around if a deal comes into a great area, and you might have to just change those metrics a little bit, right? A little smaller of a complex. Maybe it's 1988, 1999, but so it's like, I want to grow, but it's also something is that when, it's also when our properties hit returns, it's foolish for us not to even look into selling a property. Because we had investors that didn't want us to sell at the beginning of 2022 and of 2021, right? We're like, oh no, we got an offer here. It's higher than, it's going to be a higher return than what we expected, blah, blah, blah. And no one ever, after they got the wire, no one ever complained because the market had gone, you know what I mean? But the thing though is that interest rates, but it's something that we had no idea about that. We knew they were going to go up. We didn't know they were going to go that fast. So it's something that's just once you're hitting these business plans, you're executing them, you have to take a little money off the table. And it's one thing if you had if we had these properties and we're like, they're our own properties, well, I can hold them and it's not a problem. But if I told an investor 5 or 7 years, you know what I mean? And it's like, we're trying to keep within that. And so, hey, this is an opportunity. We have a good buyer that's going to come and purchase this and they're solid and our broker's like vetting them and everything's fine. Then it's a good way to go. So I think that's an interesting way of how to do it. And so I would love to buy more units. I'd love to hit like a certain number. But the thing though is that I like to do good deals and, we don't have any capital calls. We don't have any properties that aren't cash flowing. I mean, we're very lucky with where we are now, but it's really sticking to your criteria, not over leveraging, working with people that are experienced. And so whatever that yields for deals, because, it's easy to buy a lot of deals when market's going up. The thing though is that where we are now, 2024 there's going to be a lot of properties that are in trouble now and they're going to be in trouble, as these interest rate caps from 2022 expire. So it's going to be a difficult year. So
especially in the commercial space too, which is what everyone is talking about. But you mentioned overhead, you mentioned your team, you mentioned it's a small team. I'm curious, what is your team comprised of? Like who do you, who are members of your team? Like how have you built that? There's certain facets that each person is responsible for. I'm sure that's the case, but I'm curious about to the level that you're at, what does that team look like?
Yeah, so right now it's myself, I have 2 other partners, and then we have 3 other people that work with us, all part-time on that side. One's full-time, so 2 other part-time people. And so with the 2 partners, I have 1 partner that focuses on acquisitions, so reviewing deals as they're coming in. And this has been a very slow thing. 2023 is extremely slow on deals, right? And then I have my other partner, he is dealing with mainly our marketing for our firm, for everything that we do. And so it's really, those are what our main partners are. And then I have an investor relations person that works a lot with helping us read reports, helping us with getting information from asset management calls and everything like this. And, he's paramount to working with that. And then we have 2 assistants that work with us as well. So just working out with different small things. One of them does works with one of our partners that does the marketing and stuff like that. So it's it's a small team, but it's also something that we don't have to do deals. And that's, it's nice. You look on someone's website, there's 100 people or whatever working at this firm, but people got to pay those people. You know what I mean?
Yeah.
You got full-time people. You got to pay people. So it's like us not having that where we have very low overhead with just, a couple people that are working full-time, that allows it to, that allows you really to operate and do deals when you want to do deals, not when you have to do deals.
Yeah, exactly. You get into building a business and you have 30, 40 employees or whatever, and then you have to build this hierarchy and the manager, and then there's managers that manage people, and then there's kind of believe me, I'm sure that this obviously works, right? A lot of people do it, but then there's this middle ground of are you actually getting the amount of effectiveness out of each employee? Because there's so a lot of people doing a lot of different things. And I work for a family business, and we scaled it back a little bit because we found that being leaner was better for us, and it helped our salespeople be more flexible with the types of deals we wanted to bring in. Different business, but it's same principle. So, one of the questions that I have, maybe to get more personal as we wind down the show, is I'm curious, Charles, about your why. Why do you do what you do? What gets you fired up about this business? What gets you out of bed every morning? Being a real estate investor looks glamorous, like we talked about on the outside, but basically you're solving problems all day long, right? So what's the reason or the why behind the work?
So I think obviously everybody most people initially get into real estate. I just had a passion for it. As my story with it was that getting into it was that being involved with other businesses, like I said before, I was involved with the online payment business that my brother runs full time now. And it's something that the income was very inconsistent. So investing in real estate came on for me as something that it allows entrepreneurs the ability of really having an additional income stream that is not correlated to their regular business. And that's what I loved about real estate, because when you're dealing with businesses that are a little inconsistent, which a lot of people's businesses are, right? So it's something that's why I always like real estate. So it's always make money in business, invest in real estate. And now, it's a lot of work for doing that. I did it all, actively. So being able to offer that to people and let them, have the ability of getting that without, because it's difficult, like you said about the stock market. Yeah, you can do like index funds, stuff like this, but your distributions are like 1% or something. So it's like, you got to have like tens of millions of dollars to make six figures in that. So if this is something that allows you to have a higher cash on cash return over years, and it gives you another way of really diversifying your income from your business, your wealth from your business, that's not correlated to your own, because a lot of people own businesses that are entrepreneurs. It's all dependent on them, right?
Yep.
They're self-employed. So the thing though is, this is something that's coming in. If you're not there for one reason or another, you and your family are going to be taken care of by these investments, you know what I mean, that you're making. And so I think that was one of the big things, because it's something that as you put money into real estate, as you make money in your business, you put it into real estate, now you're like a sigh of relief, as you now have an additional income stream. You have money coming in that you're not every Monday wondering where, how are you going to take care of Friday, especially when you're payrolling people. So
yeah, I think one of the things that real estate taught us the most is that, they say 90% of millionaires are made through real estate. Now, we don't believe that real estate is the best way. It's a good way. We don't think it's the best way to build your wealth, right? But it is the best way to maintain, keep, and grow your wealth, right? So like the best way to build your wealth is to start something, to create a service, a product, a business that, and that could be including like being an athlete, being somebody, like providing a service that people want to pay for, right? So that's the best way to start the journey of growing your wealth and becoming wealthy. But to keep and to maintain and then to grow that, we feel like real estate is clearly by far the best way to do it. Unless, like you said, Charles, I guess you could make the argument that if you have $10 million and you just put it in an index fund, that's a good problem to have, but I don't have that problem. So, so this is awesome, Charles. I really appreciate getting to know you and your story. And we have that Florida connection. I love it down there. I'm curious, have you left anything out? Is there anything else that you want to share with our audience? Maybe the best way for people to get in touch with you, if they want to learn more about you, your story, invest with you and your team. Hopefully you're buying deals this year. Maybe there's some opportunities for people. What's the best way for people to learn more about you?
Yeah,
I know you have a podcast as well. I didn't mean to leave that out too.
Yeah,
so
no problem.
Yeah.
So it's our company is Harborside Partners. So if you go to harborsidepartners.com and on harborsidepartners.com, I have a podcast I do twice weekly. One of them is interview format like this. Another one is what I call Strategy Saturday, which is a short podcast where I go over all different types of strategies, everything about different investment formulas, anything that comes to mind that I'm doing, I will put up there an episode on it. And then YouTube channels goes with them. And then if you're interested in actively or passively investing in real estate, actively, we have to do some coaching programs, stuff like that. It's available on our website. And then we also, if you're interested in passively investing with us, you can go on to Harborside Partners there, fill out a form, speak to one of the partners, most likely myself. I usually take those calls. And we can talk about what your goals are and see when we have deals. We'll send you emails.
Love it. Cool. Charles, this has been great, man. This is, we kind of common minds. I feel like it's cool to get to know people who are doing some similar stuff that I've never met before. They're in other parts of the country that seem to be thriving. So I want to thank you for coming on and sharing your story with our listeners. It's been good to get to know you.
Thank you so much for having me on today.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.